All right, good morning, everybody. So the rally continued in the overnight. Japan basically flat. Everything else is flat to up slightly. Bitcoin is really leading this morning. Got above 73K. Expect the proxies to do well as we get closer to OPEX. It's kind of a boring day. We have nothing scheduled from Market Watch, but when we dig into FX Street, we can see we have the 30-year auction. And since it's Wednesday, we always have the crude inventories. I don't want to say they don't matter, but crude matters less compared to what it used to, say, 30 years ago. So as long as their numbers aren't wildly out of line, crude shouldn't be that big of a deal. But the 30-year auction at 1 o'clock, that one has the potential to move the markets. We've seen that already once this year. And it's possible that we could hear something out of Europe later in the morning. There are European Fed speakers, European Central Bank. So there's always that possibility. It's worth watching to see. You can just watch Finance Juice. If they start saying anything that might impact the markets, Finance Juice will post it in here. Spot Gamma didn't have the AM done, so I just shared the PM. And one of the things they talked about was the optionality levels, really just confirming what they had talked about the day before. And then they had a little bit of talk about NVIDIA, reaffirming the idea that right now the market is NVIDIA. What it does, the market does. So volumes are a little light, but that's going to be misleading. We're still going through that roll. The volume's misleading like this because it can show us trades that aren't necessarily in new position. It's not like people are getting more aggressive or trying to go long or trying to go short. They're just carrying a position over. So it's just trades that really don't have any bias to them. But this morning, the volumes are light and there is still hedging. And I mentioned this yesterday that once we got past CPI, it was possible that we were going to continue to see hedging into the later part of the week because OPEX is a really big deal. And there's still a lot of unknowns, right? There's a couple of bricks in the wall of worry. So this is just more of that example. The morning briefing is designed to teach you how to get ready for the trading day. I know it seems like I'm trying to give you a fish every day and get you ready by showing you all these things. But the goal is to get you to the point where you could do it on your own, right? So it's always been the focus. So when you come in and you see the volume light like this, you want to understand, you want to know what's going on. Why is it so light? Was there markets closed somewhere in the world? Are they sitting out waiting for something? If so, what are they waiting for? What time is it going to get here? Are they hedging or not? It helps you prepare for the day to have a better idea what has happened in the overnight hours and then what we expect to see happen today. 75 is a little light. I'd rather see it in the 80s, 90s. We've seen it lighter than this. Even just yesterday, it was at 71 instead of 75. There's no perfect number to this. I got to these numbers by looking at this every single day, after a couple of years, you kind of get an idea of what normal looks like. So it's a little light. It's not dangerously light. But if we don't know what's going on at this point, if we didn't understand why it was light, we'd certainly want to go looking around and try to find that answer. We can match that light volume with this tight range. There's a thing called IB. It's initial balance. It's kind of like open range, only it happens at Globex, and it's 1 hour long. Now, I've seen some modern analysts who want to say that IB is at 9:30 and it's an hour long. I don't want to say they're wrong or right or wrong or anything like that, but it was designed to be a Globex. There's the open range at 9:30. You can choose, a 1 minute, a 5 minute, 30 minute, 1 hour open range, whatever it is. You're in control. You choose the time. When it comes to IB, it's always 1 hour. And for me, it's always in the Globex. This 1 hour kind of sets the stage. If we have a really wide IB, then it implies that work has already been done and there might not be a lot left that needs to be accomplished at this point. Kind of asking the question, what would make them come in and trade now? They already did all their trading. But if it's very narrow, then it implies that they haven't got their work done and that they still need to come in and get that trading done. So you can mark out that open range, that IB, and use it very much like a normal trading, say like a normal open range. Throw it through the overnight, just like you would at a 9:30 open, having an open range, putting it through the trading day. Then look for breakouts above and below, crossovers, all that good stuff. This is a very narrow range through the overnight. And, we peaked a little bit to the downside. We still came back in, and we peaked out to the upside. We still came back in. And that makes sense because liquidity resides on the other side of the pivot. So when we get to the low, we expect to break through the low, go a little bit lower because liquidity is a little bit lower. Same thing with the top. When we get back to the top, we expect to break through it and go just a little bit beyond because liquidity resides on the other side of the pivot. What it starts to build is a little bit of a megaphone pattern. We see this often in a hurry up and wait environment when the market is sitting out, waiting for an event, waiting for news, waiting for something, that it sets the range and then continues to broaden that range a little bit at a time, testing the edges, going beyond, getting into liquidity, and just stretching the boundaries, widening this megaphone bigger and bigger until finally we get the event, price breaks through, leaves the zone completely, and we're off. We're in that. So we can take this low volume and add it to this very narrow range and add it to the market maker move that we see here, showing that they're hedging. And we come to the conclusion that they're worried about something, they're hedged up for it, there's an event on the horizon, and that we need to proceed with caution. And if we don't know what that event is, if we don't know why the market is so worried, then you want to call timeout and start digging through the news sites, trying to find what the market is concerned about. Because whatever it is, they're spending a lot of money. Hedges aren't trades, right? They're not like, they're not designed to be profit. They are cost. So when you see them hedging, you know that they're spending money to put those hedges on. The best analogy I can give is homeowners insurance, say against fires and floods. You don't use homeowners insurance for profit, right? You don't want to lose your home just to make a buck. So insurance is cost. Sure, you might end up getting money out of it, but that was not your goal, right? You weren't trying to turn a profit. You were just trying to protect yourself. It's the same thing they're doing when they're hedging. So when you see they're hedging, or even think about hedging, it's not a trade to make some profit. They are spending money to do it. So they're concerned, they're worried, and they're putting money on the line to protect themselves. That should provide you with a little bit of caution and make you wonder, all right, what's the issue? What is on the table that is so concerning that they're hedging up for it? This hedge has been there since yesterday. It was bigger yesterday, but some of it came off and we're still carrying it. I believe we're going to see this through the rest of the week for a number of reasons. One, with the hedge or with the rolling, we're going to see some trading happening in the front end that isn't necessarily because of the price action. So we're going to get volumes, we're going to get rolls. There's going to be trading, and this indicator is just picking up things that are in the front end. That's what it does, right? So the front end is things that are expiring today, or if we were on an equity that had weeklies, then it would be things that are going to expire on Friday. It's the closest expiring options. There's that butterfly, by the way, that 51.50. I didn't get filled yesterday. I kept trying to get filled. I wasn't willing to pay more than 15 cents for it, so I didn't get filled. Seems like it's still the same price and still not expecting to get filled yet. So this front end is matched against the next expiration out. And that's where we identify the market maker move, right? But I'm sitting here looking at this and we can see that it's not. So I think some of this market maker move is going to be because of the OPEX and the changing of the contracts. I can't prove it, but if we go back and look at old morning briefings at previous OPEX weeks, you'll see that we had market maker moves through most of that week. And then it starts to throw us off a little bit. We want to see the low volume that we had down here, the 77, and we want to see the really tight range and have that market maker move. Otherwise, if you just see the market maker move by itself, but price isn't showing that they're hedging and volume doesn't show that they're hedging, then it's very likely that the market maker move signal is off for some reason, like OPEX or some other situation like that. So when you put the three together, you can be more confident that they're hedging. One piece by itself in an OPEX week can be misleading. No, hedging is just to cover the other side, right? It's not a directional bias per se. So, you know, coin toss using the commitment of traders report, coin toss 50-50, half the funds out there are long for one reason or another, and half the funds out there are short for one reason or another. So when either side goes in there to hedge, they're not trying to call a side or call a direction and lean to the upside or downside. They're just trying to cover the other side of their own position. You can always go look up the commitment of traders report and see, are we dominantly bullish or bearish in pick your group, right? Because the commitment of traders report will have your different groups in there. But you don't want to try to use their hedge as a directional bias. You're better off flipping a quarter than trying to do that. If you want a directional tell for swings, look at the change in contracts. These are futures products, right? So look at the change from the contract that we were on at 51.82 and the contract that we're going to at 52.46. Where do they think the market's going to be by June? 52.46. Aha, the light bulb comes on. Where's their bias? To the upside. Why? Put their money where their mouth is. Right there. We are above the daily pivot. We don't have an MDP from yesterday because we hit it twice. Now you could argue on this because we just tagged it, whether or not you want to consider it hit. I don't get that down into the weeds on it. As far as I'm concerned, it was hit. But we are now building again a daily pivot point that we're above. So another MDP. This is the turnaround. If we didn't have anything else on here except that pivot point, you'd see the crossover that we had, the stabilization, the cross back again above those pivot points. There's a number of trading styles that focus on pivot points, whether you're running, Camarilla pivots, Woody's, Persons, or just the regular floor pivot. And I'm sure there's even more than that, right? There's probably a dozen different pivot styles out there. For the daily, we're not really too extended, but the weekly is way down here at 51.28. So we're getting a little bit ahead of the skis, especially for a week that's supposed to be a hurry up and wait week. Now I've tried to run different indicator combinations like we do for how far away from the 10. Instead of asking how far away from the 10, how far are we from a pivot point? I've tried that. The readings were so inconsistent that there wasn't really any value to it. And of course, that would change per product, whether you're looking at the ES, the NASDAQ, gold, whatever. So I don't have a great answer on how far from the pivot point is too far. What I've been generally doing is looking around at what we've had recently and trying to gauge if the distance that we've had recently has been met again. So if you look, say, at last week, just for an example, here is the weekly pivot point out of all that noise. I'm sure it's hard to see. And this is the highest point we got from that last week. 51.18 to 52, call it 52.50. It's not too far away. We've been farther than that. But it starts to get into the edges of how far from the weekly pivot point we want to get. And the same thing goes on a day-to-day basis with a daily pivot point or a VWAP, right? You don't want to get too far from VWAP, you'll mean revert. But we are getting a little bit extended. It's worth noting, obviously, since the pivot point this week is higher up than last week, and we haven't broke above this pivot point, then we're not farther away than we were last week when we reversed. But we're getting close. If we do manage to get above this green line that we see here, which happens to be a voodoo line that I believe they call forest, if we can get above that, we've got the ADR half, 52.64, and just above that, we got the call wall. There was a comment in chat about not being able to see the symbol that that we're talking about. So this is the ES, just to point that out for anybody who can't see. It's a good point. I kind of forget from time to time that these Zoom and live streams aren't always easy to see. So I am on the ES futures. It's a 15-minute chart. And on the right side, it's the ES, and it's a weekly chart. So if you're having a hard time streaming, if you're new here and you haven't seen this before, it will always be the ES every morning. Now I'm teaching you to do these steps. You can apply them to whatever you want. So when you're doing your own morning briefing, you don't have to do the ES. You can do SPY, QQQ, whatever. It's yours. We do have a divergence in the CVI versus price action. So we can see on this weekly chart that we've broke out above last week's range, continued to the upside, expanding farther away from the 10-week. But we look at the CVI, it's rolled over and it's pointing to the downside. Now, granted, this is the NASDAQ Composite CVI, Cumulative Volume Index CVI. And if you use the one on TradingView, rather than picking just the NASDAQ, you could pick all US markets, which is nice. Thinkorswim doesn't give us that option. If I double click on this, I can choose different indexes, the NYSE, the NASDAQ, AMEX. It's not perfect. TradingViews is better because you can pick all of these markets at once, which is nice. But on Thinkorswim, since I can code Thinkorswim, I added my Bollinger Bands, some moving averages to this, so we kind of get a feel for, midlines and turning points, things like that, standard deviation levels. But right now there is divergence between the volume and price action. Even if we were to examine something like the NASDAQ, and this isn't the index, right? This is just the futures. We've still broke out above last week's range and are to the upside, last week's weekly high. And the CVI is still pointed down. So we still have divergence, even if it is on the NQ. It's worth pointing out, and this isn't the only divergence that's going on right now. It's just one of the easiest ones to point to. A lot of market breadth tools are signaling chaos, and there's just really not a whole lot we can do about it. This is TradingView. I've got the NASDAQ composite, which is IXIC. Just remember, we don't want the NASDAQ 100 like the QQQ, because that's not what this indicator is. This indicator is the NASDAQ composite. Now, at the moment, with this setup, I have the indicator actually looking at the NASDAQ because I can lay it right on top of the NASDAQ. But I don't have to. On TradingView, instead of just the NASDAQ, you can see you can do all US total markets. And if you wanted to, you can break it down and do Dow Jones. But the US total, that's fantastic, because then you can lay it against the SPY or something and get a good picture. I've got it against the NASDAQ, and I've set it to the NASDAQ so I can look for that divergence. And I think this divergence is pretty clear. That was a significant pullback, and we didn't see anything out of that volume indicator. In fact, we're just barely starting to roll over now, and putting it on a daily, you can see it's just not responding yet. So we do have some divergence out there, but that's one minor issue out of a whole lot of issues that's going on right now. Maybe it kind of pales in comparison. The put wall 48.67 is a long ways off. If you happened to have read the Spot Gamma founders notes, they're still talking about 5,000 as a critical line in the sand, and that if we break through that 5,000 level, we're going to very likely see they don't use the words flash crash, but we'll see a risk-off environment and some violent moves for sure. Probably, very likely, right down into that put wall. Ten-day, 30-minute volume profile. We are finally getting back up to this top. It's the only way that this profile is going to change shape anytime soon. The point of control is in the middle. There's so much volume that we can't even start getting into until Friday or Monday of this week, Monday of next week. So as we get new candles to the right and we lose these candles from the left, we won't interact with that point of control for days yet. So the shape of this is only going to change if we break to the upside and start expanding higher, or we break to the downside and start expanding lower. We do now have that classic D shape. And we are lined up with TPO and point of control volume profile on both sides. We don't have a new VPOC level for today. The one that we would have had for yesterday, we've crossed through it so many times it has no value to us at this point. On this 5-minute chart, the narrow range from last night, the IB, it really stands out. To me, this is an exaggerated picture of that really tight range. The nice thing about having a tight range like this is it sets you up for some easy trade opportunities without having to wait all day. So, generally we focus on yesterday's high, yesterday's low. They're the easiest pivot points, right? The broadest, biggest pivot points. But when you have a very tight range like we have right now, sets you up for some easy plays without having to wait forever. So we already know we got the megaphone. It's not too big of a deal. But just like all the candle books say, measure the zone that you have or the range and plot your levels out from there. Now, if we're going to continue to megaphone, meaning we're going to continue to expand beyond the pivot to the next pivot, even by just a little bit, then one of the levels that we could use is the 111. That's a nice reversal area. Generally, if we're going to break through and do like a double top or a double bottom, and it's just more of a bear trap and a bull trap, price will get hung up around that 111 area. I call it the warning center, but it doesn't really matter what you call it. So right now, for an example, we've got the 100 line or the 0 line, and that's our pivot high, just like this was our pivot high earlier. Well, we broke through that and expanded up just a little bit into liquidity before we fell down. If we're going to do the same thing again, then we'll get into liquidity, expand through it, very likely into the 111, and then we'll fall down. If we overshoot it, we could get into the 1, 2, 3, 6, and then fall down. If it's a true breakout, we'll get through the 1, 2, 3, 6 and get above it, start developing some price there, and then perhaps a Busby. Same thing for the bottom side. So it's really simple to just lay out your levels. Just measure the Globex range that we have. It's not a very big range. We had a half back break. Half back is that cyan dotted line. When you get a half back break, the target is 25%. That worked out perfectly too. So simple, easy zone. All we got to do is leave the zone. You got plays to the downside, or we leave the zone. You got plays to the upside. And that's when the zone finally ends. Until it does end, we're going to continue to broaden out in that megaphone pattern. Once we truly get out of that range and start breaking down, then we can use yesterday's range. Now you can make the argument that this was event-based and just back off of that wick and use the RTH low of yesterday. It doesn't modify things very much. It just moves the center point a little bit. There's no right or wrong to this. I think you're fine either way. But whichever way you go, you kind of want to stick to it. Do the same thing every time. So very tight initial balance. Everything's wound up. And look at the point of control along the lower edge. to be fair, we've spent more time on the lower edge than we have anywhere else since we opened in Globex last night. We can see that from the TPO. Its point of control is also at the same spot. But there's a lot of volume, a lot of trading going on in the lower end of this range. All right, the weekly expected move after that nice expansion from yesterday, we're a lot closer to the upper edge, 52.62. But we're not there yet. We're expected to close inside this range 80% of the time. Easy math, you can just count back the last 10 weeks and look at how many times we closed at the end of the week outside of this range. What you'll count and find is that we're not holding that 80%. When that happens, it's a signal that things are getting violent and it's not being picked up by the volatility metrics. They're not trading it out, or right, the market makers aren't catching it. These levels that we're looking at are derived from trading within the options environment, and it's using the options average implied volatility to give us these levels. So if they trade out of the money and their trading affects the volatility, then these levels on a week-to-week basis, they change. But as a sign of a warning, if you count back 10 weeks and you notice that we're not closing inside the box on Friday 8 out of 10 weeks, and instead it's maybe 60-40, 70-30, worse, maybe even 50-50, that price is way more violent than the market is pricing in. And you don't want to do things like iron condors and credit spreads, because this is implying price is very likely to break those ranges and expand farther than you expected it to. Our 10-day moving average range here still holds true. Been working on this range for most of the year now. We're at 0.86% above the 10-day. It's not overly extreme. And in fact, we were a little higher than that. We're kind of fading back a little bit. But when we look at yesterday after a big move like that, try to ask the question, did we move too far, too fast? Are we due for a pullback, maybe a little mean reversion? Not according to this, no. Now we're 4.21%. You could just say 4.25 from the 10-week. That's kind of getting up there a little bit. We've been farther away from the 10 than that, but it doesn't happen a lot, right? So just kind of lining up this line doesn't have to be perfect. You want to avoid going back too far and getting into COVID levels, because that really kind of screws up the math. But outside of COVID, we can see just a few instances where we've gone higher than we are right now from that 10. We're overbought. We're overextended. We've got a little bit ahead of our skis, and we're due for a little bit of digestion. Now, price can correct by just pulling back, but we can also correct by sitting sideways and grinding sideways. It's called correction through time instead of correction by price. That's an actual thing, by the way. There's research and statistics and math behind it. If you go to Google Scholar and do research on it, you'll find that it's a real deal. So it's not just a fun catchphrase. So we are overextended, but that is a weekly time frame. And while we are overextended, that does not mean that price has to turn around and go back down. If we stay in one spot, the 10 will come to us. All we got to do is hold the line, price just chop about in a zone, and this will resolve itself. So we got Bitcoin up this morning, the China ADRs, and a little bit of energy. Not very much to hang our hat on. Oh, and I didn't ask, is the audio better today? I did some work yesterday trying to figure out what was wrong with the really low, really quiet microphone, and perfect. Thank you. And I forgot to ask if I had managed to fix the darn thing. So KWeb is up. We would expect to see the China ADRs up like JD, but JD's not up. Or PDD. Okay, so this one's up. Getting an inside day breakout. We closed near the highs. It didn't have very far to go to start that breakout process. See if we're through the half back yet. Oh, yeah. So we made it through the half back yesterday, and now we're just continuing that move to the upside. 123 is the next stopping point. We digest that, and then we'll start getting into the moving averages. Got BABA. Yeah, it's not up that much. In fact, we gapped down, so we're not even back to where we closed yesterday. If we were looking at where the market closed at 4 o'clock, then sure, we're up. But if we're looking at the after hours move that BABA made, we're not up, right? We're down after that. So we certainly have some work to do. All this selling that we've talked about before with all these wicks up here, and they're obviously not done yet. All right. So if this thing is going to turn around, there's a lot of work that still needs to be done. Yeah. Baidu, big strong move this morning. Nice continuation. That gets us up into 109.5. So yeah, we're halfway through this red candle here, at least, maybe a little more. That would tangle us halfway through the 20 period moving average, basically, right underneath it. That's a 20-week moving average. So it's kind of a big deal. And as you can see, it's been fighting it for a while, right? It's a spaghetti mess. But we've been under the 10, under the 20 since last year, at least. So a little pop up this morning, a bit of a continuation on the week. This would be day 4. We don't see day 4. Thinkorswim is one of those brokers that doesn't show you the pre-market price action on the daily chart until after 9:30. So this morning, we hit 109.5. We hit way up here this morning, and yet you don't see a candle here. If you're on Thinkorswim and you want to see a candle up there, one little trick that you can do is go to your time frames, go to intraday, and then set it, say 360 days and 12 hours. Since it's quote intraday, even though it's a 12-hour candle, it'll look very, very close to a daily candle. Very close. And yet it won't be, you won't be blind, right? So what I just did there should have showed it. I bet I hit Yeah, still need that number. So there we go. There's our 109. Ta-da, we made the candle appear. That's one of the reasons that I go to TrendSpider in the mornings, because TrendSpider shows that candle already, right? And so does TradingView. So it's just kind of frustrating that Thinkorswim on a daily chart won't show you that candle until 9:30 open. It's a little frustrating, but there's workarounds. So we got the China ADRs, BABA, Baidu, JD, PDD. I like a company called EDU. It doesn't have, the liquidity of some of the others, but this has been a swing that I've been in for a while now. But with the China ADRs, might see a little bit out of XPEV or maybe NEO. Bitcoin, crude, and then KWeb through the China ADRs. We're getting a little bit of precious metals too. So silver, energy, gold's not quite there yet. It's working in the right direction. But let's pull up the China ADRs and see if what else is in there, because it's very likely just a few names that moved really big and brought that ETF to light. Just walking too fast. It's hiding at the top. And Billy's up 2.2. Billy's been trying to turn things around for a while now. Then PDD, Lou. Surprised we're not seeing any of the other good ones. So they are up, but a couple of these are up enough that that the ETF KWeb is actually getting some light. But I mean, I wouldn't mess around with this thing, right? This is some penny stock trash. Same with this. I don't care that they're up 33%, right? This is just some trash stuff. So maybe the ETF is a little off this morning from some of those names. And there's, of course, Baidu up 2.5. So they got a good start, but I would focus more on the Bitcoin proxies since the China ADRs look so nasty this morning. MSTR up 3.25. Mara more than 2.75. GBTC 2.5. So that's a good start. Focus on the Bitcoin proxies, maybe a little bit on the China ADRs. Watch the NY Fang group, see if they start to turn around a little bit. We want to see US dollar Japan reject against these highs and begin to fall down for exactly this reason right here. We want to see that dollar pull away from 103. Now, generally speaking, the dollar moving down should be a tailwind for the market, but instead it's just not a headwind. We seen yesterday the 10-year US dollar Japan and the Dixie, all three moving to the upside while the S&P and the NASDAQ were also moving to the upside. So they weren't interfering with the market at all. The market just shrugged it off and just didn't care, right? Everything was going up yesterday. So it's not the idea that, we're getting price moving to the upside or not. It's where are we at? What level are we at? Like swag levels. So keep the dollar below 103 if we can. Want to continue to see it fade off, but we don't want any exaggerated moves, nothing, real big flashy moves like yesterday. We don't want that. And preferably we want to see these moves in the dollar and the 10-year to match what's going on with US dollar Japan. So we can see already earlier we had this move in the dollar. We're not really seeing the same move in US dollar Japan over here. Same thing with the 10-year. It's actually going in the other direction. So these are the kind of dangerous things that throw off our tools and our signals. We got the 10-year heading up, a little aggressive, I gotta say, while the Dixie or the dollar index just broke the 3MA and is headed to the downside. Kind of sharply too. So some serious divergence here. And that makes everything else dangerous. Proceed with caution. Something's up. All right. So be careful, be safe.